Good afternoon, folks. And here we are at the end of another week and time for weekly wrap. So here I am looking at the trend map in this week's ET Wealth. And it doesn't look very good. 2026 calendar year, year to date returns in rupee terms for international markets, and India is at the bottom of the heap with Nifty 50 return of minus 2.5%. And just one step above, like we spoke last time, is the US's S&P 500 with a 0.3% gain. Mind you, this is in rupee terms. In dollar terms, it would have been lesser because the dollar depreciated against most of the currencies in the world, not against the rupee though. So when you're looking at in rupee terms, makes sense for us, but for an international investor, India would have, the Indian returns would have been below ground, and US just way above there. And top of the chart is Brazil and followed by Mexico. EMs have done pretty well actually, and largely because valuations were in their favor, and there was a good amount of trade going away from America into the rest of the world. And with valuations being in their favor, EMs have attracted. And also knowing that in this cyclically there's a change that is coming through. So many years of EM underperformance is now getting reversed. Korea is not there in this trend map. If Korea was there in the trend map, it would have been way out of the sheet. Okay, and without doubt, the topper for the year, for the last 12 months and for the last year, it had fallen horribly in the aftermath of the tariffs. And then given its presence in technology, AI and robotics, and the better negotiation that went through, markets jumped out. I guess there were governance issues also which were sorted out. But yes, Korea was a star performer the last few months, and that is where we are. Indian markets have been having not an easy time, a tough time, and especially in the area of infotech, IT services. IT services have taken a hit. We spoke about it last week too. 20% drop in 1 month isn't a joke. So the IT index has fallen almost 20% in 1 month's time. Haven't seen this kind of a rout in recent years. I don't remember such a rout in recent years. Even in the wake of the H-1B visa issue, we didn't have such a fall, as much as was caused by the Citrini research report, and before that, the Claude Anthropic CEO's comments that really put into doubt about the future of IT services. So it's not just Indian IT service companies that have fallen. Even an IBM has fallen as much, and Accenture has fallen, Oracle has fallen. Wherever Microsoft has fallen, arguably may not have been for the as much corrected, but then all these companies have fallen 14 to 20%. They have fallen, just like the biggies in India have all fallen in the region of 15 to 20%. A slight recovery is underway, largely because it has anything that has fallen so much, there's bound to be a bounce back. And that is so. While I think many of you would have gone through the basics of the Citrini research report, I thought I will speak a little about the counter points to that. Okay, the Citrini report is all over WhatsApp, it's all over Twitter, X, it's all over newspapers. So I'm sure you've got good, you've already discussed it with your friends and seen it over WhatsApp. It's a typical doomsday report, and the kind of penchant humans have for doomsday movies. I mean, all doomsday movies are blockbusters if you think of it. And similarly, the Citrini research, which gives a doomsday picture, has been a major hit. I don't know why we like these doomsday prophecies more than the good-looking prophecies. Okay, I don't think we have too many of the good-looking prophecies though. But here we are. Broadly, the Citrini research was work in imagination. Okay, the report was basically an imagined 2028 economic scenario post the adoption of AI, and it basically said that we would be having massive unemployment by the time 2028 happens. We'd be looking at a kind of a 10.8, 11% unemployment, white collar jobs phased out, huge defaults on consumer loans and mortgages because so many white collar jobs would have been lost. And while the GDP looked good, actually the man on the ground would be suffering with a low income, and consumption would be hit, and so on and so forth. And that caused a huge amount of debate. There were quite a few rebuttals to this report, by the way. And I will take up one report, a credible source, I would say, by Citadel Securities, a large financial research firm based in the US. And this countered with more logic and data, whereas the Citadel report was a lot of assumptions without enough database and more on letting the mind go riot. This has a lot of data, and it does look back at some of the historical instances to talk about what happens when we have disruption in a technology happening. Okay, so to start with, this report calls it the 2026 global intelligence crisis versus the 2028 global intelligence crisis that the Citadel report was called. Okay, and here he is showing us some data, whereas the current unemployment rate in the US is 4.28%, and the capex in artificial intelligence at $650 billion is about 2% of GDP. Okay, and approximately 2,800 data centers are planned for construction in the US alone. This is a US based report, so it's more US centric. Okay, in spite of the current displacement narrative, job postings for software engineers are rising rapidly, up 11% year on year. One would think that these jobs are being cut down and more unemployment in this space, but actually the number of software postings are going up 11%. There's a huge divergence between narrative and fact. We should always keep looking at that. Okay, and the author here says that, see, it's so difficult for the best of economists to even forecast a 2-month payroll revision. And here we are talking about a 2-year out and 3-year out, talking about massive job losses and consumption changes. So it's not easy to get any kind of reliable accuracy here. And we should not get so worked up by this report, which, as I said, possibly has more of imagination in it. Okay, so the entire narrative of the 2028 report assumed that what he calls the speed of diffusion and how quickly AI is adopted in the workplace. Okay, it's all based on that. So while the Citadel report assumed a very fast, rapid rate of adoption of AI, and this report by Citadel says otherwise, based on actual surveys done by the St. Louis Fed. Okay, and they've taken data from there, and it seems that actually the adoption of AI in the workplace is pretty low. And going by this kind of rapid scaling up narrative, going by the fact that AI is advancing at a rapid pace, but adoption is not at a rapid pace, is what this data is saying. So actually, if you go by the Citadel report, the curve of adoption should be like this, but the St. Louis Fed's data says adoption is like this at a low, very stable. So it does go to say that maybe we are running ahead of ourselves as far as adoption of AI goes. So what the report says about this is, the data seems unexpectedly stable and presents little evidence of any imminent displacement risk. Let us note that. Okay, so here we are talking about how technology adoption generally happens and has happened in the past, even where we had disruptive technologies or life-changing technologies such as the internet, which came to us in just before 2000. Okay, just because I'm reading here, just because AI systems can improve themselves or accelerate their own capabilities, commentators are extrapolating a future in which automation and productivity compound indefinitely at exponential rates. That is the assumption. But actually, technological diffusion has historically followed an S curve. So in an S curve, initially adoption is slow but expensive, and then as the marginal cost of the new technology come down, adoption is higher and eventually plateaus out. That is how it has been at other times. Okay, so he says here, early adoption is slow and expensive. Growth accelerates as costs fall and complementary infrastructure develops. Please note, complementary infrastructure should be developing. Eventually, saturation sets in and the marginal adopter is less productive or less profitable, which causes growth to decelerate. But here, initially costs are high and growth is low, then growth falls, but all the time assuming that complementary infrastructure is up. So here, actually, many experts have pointed out that we are going to have a bottleneck as far as infrastructure is concerned. The rate at which AI is developing is not the same rate at which the infrastructure is developing, and infrastructure takes time to develop and huge capital to develop. So we should be mindful that we would hit a roadblock somewhere along the way, and we will not see that same rapid pace of implementation that one thinks they would see. And even as I speak, the difficulties are on the ground, are felt. So I was recently speaking to the consumer head of one of the world's largest banks. Okay, and she was telling me that even for a bank of that size with unlimited or rather large resources at their command, they have not been able to introduce a consistent, reliable chatbot on their web services, because they find that the chatbots using AI are not giving out consistent answers, and definitely when tricky questions are put, it is not at all consistent. So that is where we are. There's a huge gap between what the narrative is and what the on-ground adoption is. Hallucinations are still a worry. In some areas, by adoption of certain technologies which are more expensive, hallucinations have come down, but in general, it still seems to be a worry. I mean, you might even be reading my blog that I put up a couple of weeks back on who's hallucinating, machines or the human. So maybe when you find time, go on to our website and have a look at that blog. Okay, and yes, job losses will be there, but as some of the experts again say, that while there would be displacement over time, many of these are in the Gen Z and the younger people who will learn to adapt quickly and upskill themselves to take on the mid-level jobs where they get to use AI tools more. Okay, and more CEOs and leaders in the business, who I assume know more because they are leaders in the tech businesses, say that AI will be more used as a complement with their software services. Okay, so software services are not going to go out of fashion. No way. You may only find some bottom level. I don't want to trivialize by saying only, but yes, you will find bottom level jobs going out, and many of them will have to upskill. Okay, and then we go on to a little more explanation of why it is not going to be such a doomsday scenario. It says productivity shocks are something like supply shocks. Okay, and the AI driven automation is basically a productivity shock. Productivity shocks are positive supply shocks because they lower marginal costs, expand potential output, and increase real income. Okay, so while in isolation it could be disinflationary and growth enhancing in the medium term, but historically every major technological advance, whether it was steam power, electrification, the internal combustion engine, or computing, has followed this pattern. The counter argument suggests that AI differs because it displaces labor income directly, thereby suppressing aggregate demand. So if firms produce more at lower cost, prices fall or margins expand, or both. Okay, so lower prices actually improve real purchasing power, which should be increasing consumption. So if you think that AI is a great productivity tool. Costs of production should come down, improving real income, improving real savings, and hence consumption. Okay. On the other hand, from the side of the corporate or the business, higher margins increase retained earnings and investment capacity. Okay. So if output rises and real GDP increases, then by national income accounting identity, something must be rising on the demand side, which is consumption, investment, government spending, or net exports. Okay. So a scenario in which productivity surges but aggregate demand collapses while measured output rises violates all accounting identities. So it's not likely to really turn out in that manner. And also in this extrapolation, one forgets that large economies akin to nature are self-correcting mechanisms. Okay, we assume that a situation will be allowed to go on and on without control, but actually there is intervention. There are steps taken, and in these cases it's the governments that should be taking steps, and there will be fiscal measures introduced, there would be monetary measures introduced to correct the situation. So we are forgetting that in democracies corrective situations will not be taken. I'm sure they will be taken. He says here, democratic nations facing such displacement risk would generally be expected to err towards in regulatory and fiscal policy shifts that offset the worst case outcomes, further limiting substitution elasticity. Okay? So we need to keep in mind that large countries, large organizations would be up to something, and they have the ability to correct a situation. Okay, and yes, he says again, it seems more likely that AI will be a complement rather than a substitute for labor in many areas. A very interesting note with in his conclusion, he says, in 1930, one of the greatest economists the world has seen, John Maynard Keynes, he wrote Economic Possibilities for Our Grandchildren. This was written in 1930. Okay, and he says that predicting that productivity growth would be so powerful that by the early 21st century, the work week would fall to 15 hours only. Okay, he was directionally correct about productivity growth, but profoundly wrong about labor market implications. Rather than working dramatically less, societies consumed dramatically more. Why? Because our needs are endless. Given the chance, we would rather consume more. And if we have time and ability to work a little more so that we can consume more, we are going to be doing so. Okay. So even Keynes underestimated the elasticity of human wants. So let's remember that this thing about AI is not a straight extrapolation, bound to be an S curve, and is bound to have intervention to sort of moderate the disruption and the economic pain it would cause. So much about the Citrini versus the Citadel report, friends. I hope I haven't bored you. Okay, but if I go on in the mint, okay, of course, today's paper talks about the new regulations by SEBI and for mutual funds, and they've removed some categories, allowed new categories. Okay, they have removed what is called solution oriented schemes. So you had these schemes which say, okay, retirement oriented or children's education oriented, but more or less these were all just flexi cap schemes packaged in a different manner. So I think SEBI was right in scrapping these, which only serve to confuse and serve to be marketing gimmicks. Okay, but what they have introduced is long-term funds, okay, where as it goes towards maturity, the asset allocation changes. Suppose you were to invest in a 30-year fund, which would start with being broadly equity oriented, and then as it goes closer towards maturity, it would be more and more debt oriented. So it's basically de-risking as one gets closer to the goal. So such kind of funds would be more useful to somebody who's a do-it-yourself investor, for example. Okay. And even we as planners and advisors, what we do is as the investor goes closer to the goal, we want to de-risk the portfolio. In the sense, any volatile elements would be taken out and substituted by elements of low volatility, like a liquid fund or a low duration bond fund instead of an equity fund or a high duration bond fund, so that you're improving the predictability and you're protecting the capital that has been accumulated. Okay, so these funds would also do the same. In that way, it is good for a DIY investor. The other thing is, which is good, SEBI insists that if you are having a thematic or a sectoral fund, it should not be having more than a 50% overlap with any other fund that they have. Okay, so very often you would find that a sectoral fund and flexi cap, for example, have so many common stocks. You wonder, why is this called a thematic or a sectoral fund? So now they insist that if you're calling it a sectoral or a thematic, it better be different in spirit and in word and in portfolio, which I really appreciate. As we go on, there is an article in the Business Standard edited by Debashish Basu, and he says there seems to be a silver lining as far as small caps are concerned. The entire worry has been that small cap and mid cap valuations have been very high, and we may not be able to justify those valuations with earnings growth. But the Q3 results that came out showed a reasonably good performance by small cap companies. So, and even the micro cap, by the way. And we are hoping that this is sustainable. I would say it is a little early to call it sustainable, but it is good that Q3 results were better than expected as far as small cap companies go. Okay, an interview under Money Guru on passives, and here the interesting part about this whole thing in the passives, of course, he's not talking smart beta, he's talking about market cap based indices. This is for a do-it-yourself investor. Maybe it's good if you can combine, as per your risk profile, a Nifty 50 or a next 50 and a mid cap index or a small cap index as per your risk profile, and you can still use passives to create a portfolio across market capitalizations. Okay, and about sector or thematic funds, obviously they are higher risk, and he says that you should only have sectoral or thematic funds as a satellite part of your portfolio, not your core portfolio. Okay, and ideally choose sectors and or thematic funds that are non-correlated with each other. Okay, so this is difficult for a DIY investor, but if you have access to a good advisor, then you would be able to ask for such things to be accommodated in your portfolio, that the sectors or themes be having a very low correlation to each other. It's difficult to get non-correlated in the same asset class, but you can definitely look for a low correlation amongst these sector funds, as that's what he's saying. So that's all for this week, folks. Thank you so much. Have a nice weekend and see you next week.